Discover the jaw-dropping tax secrets of the wealthy elite. From legal loopholes to clever deductions, we're exposing the shocking truth about how the rich minimize their tax bills and maximize their wealth. You won't believe the tactics they use to stay ahead of the game. Get ready to have your mind blown and your financial knowledge expanded. I'm diving into the surprising tax secrets of wealthy people that you won't believe. Can I uncover the truth behind their money-saving tricks? Did you know that some of the wealthiest individuals in the world pay a lower percentage of their income in taxes than the average worker? In fact, a 2021 ProPublica report revealed that the 25 richest Americans, people like Jeff Bezos, Warren Buffett, and Elon Musk, paid an average federal income tax rate of just 3.4% between 2014 and 2018, despite amassing billions in wealth. How is this possible? The answer lies in the many tax loopholes and strategies that the rich use to minimize their tax burden. From offshore tax havens to charitable donations, wealthy individuals have access to a range of tools that allow them to reduce or even avoid taxes, often in ways that seem completely legal but are largely unavailable to the average taxpayer. So, how do the ultra-rich manage to pay so little? The strategies they use might surprise you. There's a common perception that the wealthiest individuals in society pay their fair share of taxes, especially given the high-profile nature of their earnings. We often hear about billionaires contributing large sums through charitable donations or paying taxes on their incomes, but the reality is much more complex. In fact, many of the ultra-rich end up paying a significantly lower percentage of their income in taxes compared to the average worker. The discrepancy starts with how income is taxed. For most Americans, income from wages is subject to a progressive tax system, where the more you earn, the higher your tax rate. However, for many wealthy individuals, a large portion of their income comes from investments like stocks, real estate, or business ventures, assets that appreciate over time. When these assets are sold, they're often taxed as capital gains, which are taxed at a much lower rate than ordinary income. For instance, the top federal tax rate on long-term capital gains is 20%, while the highest income tax rate for wages can reach 37%. Moreover, the wealthy often take advantage of tax loopholes that allow them to reduce their taxable income in ways that are unavailable to the average person. For example, they can use offshore tax havens to shelter wealth in low or no tax jurisdictions, or they might engage in estate planning strategies that transfer wealth to heirs without triggering estate taxes. Additionally, many wealthy individuals invest in tax-advantaged assets like municipal bonds, which generate income that is exempt from federal taxes. While middle-class workers pay a significant share of their income in taxes, wealthy individuals often structure their finances in ways that reduce their tax burdens. This is why it's not uncommon for billionaires to pay a lower effective tax rate than people earning far less. For instance, in 2021, Elon Musk and other top billionaires were reported to have paid very little in federal income taxes relative to their wealth, with some paying an effective tax rate of less than 4%. These discrepancies highlight a key issue in the ongoing debate about tax fairness. Many argue that the current tax system disproportionately benefits the wealthy, who have the resources and knowledge to exploit loopholes, while the middle class bears the brunt of the tax load. This has led to growing calls for tax reform, with proposals aimed at closing these loopholes and ensuring that the ultra-rich contribute a fairer share to the nation's finances. One of the most surprising and controversial tax secrets that wealthy individuals use to their advantage is the step-up in basis rule, which allows them to pass on wealth to heirs without triggering capital gains taxes on assets that have significantly appreciated in value. Here's how it works. When an individual sells an asset, such as real estate or stocks, they are typically taxed on the capital gains, the profit they made from the asset's increase in value. However, when the asset is passed on to heirs, the value of the asset is stepped up to its current market value, not its original purchase price. This means that if the heirs decide to sell the asset later, they will only pay taxes on the gain from the date they inherited the asset, not from when it was originally purchased. For example, let's say someone bought a property for $100,000, and it's worth $1 million when they pass it down to their children. Under the step-up in basis rule, the children's cost basis, for tax purposes, is $1 million, the value of the property at the time of inheritance, rather than $100,000, the original purchase price. So, if they sell the property for $1.2 million, they only pay taxes on the $200,000 profit, rather than the $1.1 million gain that would have been taxed if they had sold it immediately after the original owner bought it. This rule, which is often used in estate planning, allows the wealthy to effectively pass on huge amounts of wealth without having to pay the full tax burden that would normally apply to the increase in value. It's a powerful tool for wealth preservation and can significantly reduce or even eliminate taxes that would otherwise apply to capital gains. The controversy around this tax strategy stems from the fact that it allows individuals with significant wealth to pass on assets without paying taxes on their gains, further concentrating wealth in the hands of the heirs. Critics argue that it is an unfair loophole that disproportionately benefits the rich, enabling them to perpetuate their wealth across generations while avoiding taxes that middle-class families would face if they sold similar assets. Some have called for reforms to close this loophole, but it remains a key feature of wealth transfer strategies for the wealthy. Wealthy individuals often use various strategies to reduce their tax liabilities, some of which can be surprising. One of the most well-known techniques is using offshore tax havens. Many high-net-worth people set up offshore accounts or companies in countries with low or zero income tax, such as Bermuda or the Cayman Islands, to avoid or reduce taxes in their home country. While this is legal when done properly, it has sparked controversy, particularly when used to hide wealth or evade taxes. Another common strategy is the step up in basis rule. When wealthy people pass assets like real estate or stocks to their heirs, these assets are reassessed at their current market value instead of their original purchase price. This allows the heirs to sell the assets later at a much lower capital gains tax rate, resulting in significant tax savings for the family. This strategy is often employed as part of estate planning. Charitable donations are also a key tactic. Wealthy people often make large charitable contributions, either directly or through private foundations, to reduce their taxable income. Some use donor-advised funds, which allow them to claim an immediate tax deduction while maintaining control over where the money goes in the future. Tax-advantaged investments are another important tool. Many wealthy individuals invest in municipal bonds, which generate tax-free interest at the federal level, and sometimes at the state level as well. Real estate investors also benefit from tax incentives like depreciation, which allows them to offset rental income with paper losses, thereby reducing taxable income. Trusts are frequently used to shield assets from estate taxes and pass wealth on to heirs. Wealthy individuals set up trusts to avoid probate and minimize taxes. Irrevocable life insurance trusts, for example, allow assets to pass on without triggering estate taxes. Retirement accounts like 401ks, IRAs, and Roth IRAs are another way the wealthy defer taxes. Contributions to these accounts reduce taxable income, and Roth IRAs, in particular, allow for tax-free growth and withdrawals. This makes them an attractive vehicle for long-term wealth building. Real estate investments are also rich with tax loopholes. Wealthy individuals often depreciate properties, reducing their taxable income even when the property increases in value. The 1031 exchange allows investors to defer taxes on profits from selling real estate if the proceeds are reinvested in similar properties. Many wealthy people also structure their income to benefit from the lower taxes on capital gains compared to ordinary income. By deriving a significant portion of their income from long-term investments, they can take advantage of lower tax rates on capital gains rather than paying higher taxes on salary or wages. Business owners use various tax credits to lower their liabilities. For example, the Research and Development (R&D) tax credit lets businesses deduct some of their innovation-related costs. Wealthy entrepreneurs often establish companies in ways that maximize these deductions to reduce personal tax burdens. Another tactic is using debt strategically. Wealthy individuals may take out loans to invest in income-producing assets, writing off the interest payments as tax-deductible expenses. This approach is especially common in real estate and business ventures, where interest costs can be substantial. Investing in private equity and hedge funds is another strategy used by wealthy people. These funds often use techniques to minimize taxes, such as generating income that is classified as long-term capital gains, which is taxed at lower rates than ordinary income. Lastly, income splitting is a strategy used by some wealthy families. By transferring assets or income to family members in lower tax brackets, they can reduce the overall tax liability for the entire family. This can be done through gifts, trusts, or other mechanisms that shift income from high earners to lower earners. While all of these strategies are legal when done correctly, they often require careful planning and sometimes attract government scrutiny. Tax laws are constantly evolving, so some of these tactics may face stricter regulations or be phased out in the future. If you're shocked by these tax strategies and want to learn more about how the wealthy navigate the system, don't forget to like this video and subscribe to stay updated. We dive deep into topics like this and explore the hidden truths behind tax loopholes, helping you understand how they impact you and the economy. Hit that notification bell so you never miss out on the latest insights.